Hello, and welcome to KPMG's podcast on ASU 2014-01, Accounting for Investments in Affordable Housing Projects. My name is Jim Simon, and I am a Senior Manager in KPMG's Department of Professional Practice. In the next 10 minutes or so, we will discuss the ASU issued by the FASB, which is effective for public companies with annual periods beginning after December 15, 2014. The Affordable Housing Tax Credits, also known as Low-Income Housing Tax Credits or LIHTCs, were first enacted in 1986 and made permanent in 1993 and are designed to encourage investment in the construction of low-income housing. The credits are available to investors in limited partnerships that own these projects. The investors in these projects typically expect a return solely based on the tax credits and other tax benefits generated by the investment. Prior to the issuance of ASU 2014-01, EITF 94-1, or as codified ASC 323-740, provided guidance for the accounting for these investments. If certain criteria were met, an investor could apply an effective yield method where a constant yield was calculated for the investment and the entire investment was accounted for through the income tax line. If the criteria were not met, the investment would typically be accounted for as an equity method investment. Under the equity method, the operating results of the investment, which are typically operating losses, are recognized as part of income from operations, and the tax credits and other tax benefits allocated to the investor were recognized in the income tax expense line. To separate the tax components from the other components was not indicative of the economics of the investments. The criteria were seen as overly restrictive, and less than 5% of investments were accounted for using the effective yield method. As such, the issue was added to the EITF agenda. The task force reached a consensus, and the FASB endorsed the criteria on this slide for an investment to qualify for accounting for LIHTC investments using the proportional amortization method. We'll walk through the proportional amortization method using an example shortly. The criteria identified were meant to expand the number of investments that qualify for the net accounting on the income tax line. A key change from EITF 94-1 is in the first criteria. Under 94-1, the credits had to be guaranteed by a creditworthy investor, which resulted in less than 5% of these investments being accounted for under the effective yield method. Under the new criteria, it only must be probable that the credits will be available. The second criteria was put into place in order to ensure that the investments that qualify for the proportional amortization method are truly investments in tax credits and other tax benefits. The standard references ASC paragraphs 323.10, 15-6 through 15-7 to evaluate whether the investor has significant influence. This subsection relates to the indicators of significant influence in the context of applying the equity method of accounting. The reference does not include the quantitative indicators of significant influence, for instance the 20% threshold related to equity method investments. The reference is strictly related to the qualitative indicators, which include items such as representation on the board of directors and participation of the investor in policy-making processes. The third criteria is also less restrictive than 94-1, in that under 94-1, the projected yield must be positive based solely on the cash flows from the guaranteed tax credits. The new criteria requires the return to be positive considering both the tax credits and other tax benefits. The other tax benefits typically are the operating losses from the investment that are often largely made up of tax depreciation. The EITF reached a consensus that certain transactions that the investor might have with the investment should not preclude the investor from applying the proportional amortization method. If the investor is in the business of entering into these types of transactions, the transactions are at market rates, and the investor does not have significant influence as a result of the transaction, the investor can disregard the transaction when evaluating whether the investment met the criteria under ASU 2014-01. For instance, if a bank that invests in a low-income housing project and subsequently provides a loan to the investment, and the bank typically enters into those types of loan agreements, and the terms of the loan are at market rates, and there are no provisions in the loan that give the bank significant influence, the bank can ignore the loan for purposes of evaluating the criteria on the previous slide to apply the proportional amortization method. An investor that meets the previously discussed criteria would account for the investment using the proportional amortization method. Under this method, the investment is amortized in proportion to the recognition of the tax credits and tax benefits related to the investment on their tax return. The amortization, together with the credits and other tax benefits, would be included within income tax expense. Deferred taxes are not recognized on the basis difference in the investment when using the proportional amortization method. And this is because the amortization of the book balance of the investment is calculated and recognized in proportion to the recognition of the tax credits and tax benefits on the tax return. Further, this method is analogous to the purchase of tax benefits, which is addressed in ASU paragraph 740-10-55-199 through 55-201. Now we'll walk through an example that will help illustrate the proportional amortization method. SaveRight Community Bank makes a $100,000 investment as a limited partner in a qualified affordable housing project in exchange for a 5% limited partnership interest in the project. The partnership finances a $4 million project, which is funded 50% in equity and 50% in debt. There's an annual tax credit equal to 4% of the original cost of the property for each of the first 10 years, with a minimum investment commitment of 15 years. Depreciation is recognized on a straight-line basis over 27.5 years, and the total deductions are limited to the initial investment of $100,000. The annual book and tax loss is equal to the depreciation expense and deduction, and the project is otherwise considered break-even, and SaveRight's tax rate is 40%. This slide illustrates how the investment will be accounted for each year based on the information noted on the previous slide. As you can see, the total tax credits and other tax benefits that are recognized over the life of the investment are $120,000, which is the total of column F. As such, the amortization of the $100,000 investment is calculated by taking the $100,000 and dividing it by the total tax credits and other tax benefits of $120,000 and multiplying that by the total tax credits and other tax benefits recognized in that year. So for year 1, the amortization of $9,091 is calculated by taking the total tax credits and other tax benefits for year 1 in column F of $10,909 and multiplying that by the ratio of the investment of $100,000 to the total tax credits and other tax benefits to be recognized over the life of the investment of $120,000. Notice that no deferred taxes are recognized on the basis difference in the investment. Let's walk through some of the other considerations you might have as you are adopting this standard. The task force decided to include a practical expedient where the investment could be amortized in proportion to only the recognition of the tax credits. This will only be allowed in circumstances where the end result is substantially similar to the proportional amortization method. Under the standard, you would evaluate whether or not the investment meets the criteria if there is a change in the investment or a change in the relationship with the investment that could result in the investment not meeting the criteria. For instance, we discussed earlier a situation where a loan was made by the investor to the investment, and that loan was not considered when evaluating the criteria that needed to be met to apply the proportional amortization method. Let's say the investment defaults on the loan, which results in the investor obtaining control of the investment. That would trigger a reevaluation of the investment under the standard. Impairment of the investment is evaluated using a more likely than not threshold, and it is applied to the carrying amount of the investment. Now, you could realize your investment through the tax credits and other tax benefits you are allocated, or you might be able to sell the investment and recoup the carrying amount that way. Either way, if you consider your investment impaired, it probably also means that you don't meet the criteria to continue to apply the proportional amortization method. Now, because the amortization of the investment, the tax credits, and other tax benefits are all recognized directly in the income tax expense line, they would be considered permanent items. The effective rate used to record income tax expense on an interim basis should reflect the impact of these investments. There are new disclosure requirements under the standard that in general are meant to allow users to understand the nature of the company's LIHTC investments and the impact those investments have on the balance sheet and income statement. The standard provides some suggested disclosures that would help meet this objective. These disclosures should be made regardless of the method of accounting. The effective date for public companies with calendar year ends is Q1 of 2015. Retrospective application is required, and early adoption is permitted. For those companies considering adopting for 2014, you should look at the guidance in ASU 250. When at all possible, the expectation would be to apply in Q1 of the year of adoption. If you adopt in a quarter other than Q1, keep in mind there will be a requirement to restate each of the prior quarter's results within the year-end filing. Thank you for listening today, and for additional information, please visit KPMG's Financial Reporting Network, which includes defining issues, webcasts, and other podcasts related to relevant accounting topics.